Welcome to Better Credit, Better Home, your source for the latest local and national news that can impact you if you are in the market for real estate. Here are your hosts, the Kingwood mortgage guy, Mike Durr, who uses his 25 years as a mortgage professional to help people improve their credit, and Joe Salas, an accomplished home inspector, real estate agent, and trainer of new agents for Byrd Property International. Together, they will help you understand what you need to know to get the most out of your real estate investment. Let's get started.
Let's get started. Well, thank you for you guys that are out there. We appreciate you showing up and interested in the information around real estate and interest rates and what's all's going on. I think I've got a good show for you today. My co-host, oh wait, what? I was just getting ready to say he's not going to be here. Look out, he shows up. What's up?
I didn't break any speeding laws, I promise.
Well, welcome, my friend. Welcome. So tell everybody what you've been doing.
Oh man, so I deal with investors. I think I've talked about it on a show previous. This business is a lot about what you know as well as who you know. And it's always good to know the people that like to buy a lot of houses. So I have these searches set up for these investors, found a perfect opportunity for one of them, sent them the email. Next thing you know, we're in contract. So I had to go meet them out there today to collect the earnest money check so I could deliver to title for them. But yeah, man, we're closing in less than 3 weeks. Cash deal.
Congratulations, man. Going under contract. That's a good thing.
Yeah, I love it.
Well, that works good. You know, it's interesting. And I had pretty much all planned out what I was going to talk about today. And I had two people contact me. Two of my past clients contacted me about buying a second home. And, this show is all about buying homes, but we really focus on first-time home buyers. Today, we're going to take a little bit of a little adjustment and put it to people that already have a home and they may want to get a second home. So we'll dip our toes into that little water, but there are a lot of opportunities. And I think the big news today was about home appreciation. And again, for first-time home buyers, that's really not that great news because that means they're going to be paying more for houses. But for the 67 to 63, I forget exactly what the number is, of the people that already own a home, that's good news. That means that the homes are continuing to increase and that the investment that we made when we made it, some longer, some shorter, but all of the appreciation we have gained, and that allows us some flexibility to do other things. So that's what we're going to talk about today. And then I will put this slide up there so we can see just that. But home appreciation continues even though housing sales fall. That's the headline. And what I'll do is we'll just get into this real quick here. I'm going to expand the size for my own self. All right, so these are the specifics. Home appreciating everywhere. Homes appreciating everywhere. So what's interesting, this is not a local deal. I mean, even though it is a valid deal for us right now, but it's across the entire United States. And we're going to talk about why that is. And in the next little subtitle there, inventory remains low. That's a big factor. And we'll see some charts that show that. The negative part of real estate right now is home sales are down and rates are up. And that's probably the reason home sales are down is because rates are up. I think earlier in the year, I was preaching that rates were going to go down and we just kept thinking and hoping and none of that seemed to work. And so I'm not sure right now where rates are going to end up. But all I can tell you is we have changed our bias to floating to lock in pretty quick just because of the thing. And I'll show you a copy of the bond market today. I'm going to talk real quickly about auto workers. Again, I know we talked about it last week. We're going to talk about it again. And we're going to also talk about some additional things about the government shutdown very shortly, very quickly. that I didn't mention last week. I didn't even think about it, to be honest with you. And then we're going to talk the rest of the time about considering buying a second home, the positives and the negatives. All right. Does that sound okay with you, Joe?
Sounds delicious.
Delicious. All right. So this is going to whet your appetite here. This is a chart that I've used before. It's actually a spreadsheet, and it talks about 73, 7, and 1. So 73 wins, 7 losses, 1 tie. And what this is this is the positive appreciation since 1941. Now, the only reason it's from 1941 because they probably didn't track it before that. But this is the modern era. So you can see on here on the right side of your screen, in 42, there was a 3%. And then in 46, there was a 24% increase. In 47, a 21% increase. And that had to be around World War II. I mean, that was right there when everything was happening. But even after those crazy amounts of appreciation, you can see it went down from there. But 1953, 12%. Go down again to, well, gosh, it was a long time before we had surmountable, a really crazy appreciation. But 69, 7, 8%. 74, 10%, 77, 10, 16, 14%. I mean, those are times like we are in right now. So we're going to fast forward into the 2000s. In the 2000s, the big losses were in 2007, 8, 9, 10, 11. Yeah. Those were the years where we had the mortgage crash. I mean, that was the worst time in mortgage history. And we'll see on another slide one of the reasons why that happened. And then here we are at 2021 and 22, and 2022, 6%, 2021, 19%. Let me tell you, we've got expectations for 2023. Everybody thought 2023 was going to be a negative, and it's not. I mean, it's way up compared to particularly what people anticipated. So if you wanted, what is that? That's about a 90% chance that when you buy a home, assuming that you buy it properly, you have professional advice, you have professionals working with you, that you're going to end up in a pretty good spot buying a good house. So I think that's going to kind of start us off.
Yeah, and even if you look at it, Mike, the years that they didn't have appreciation, if you held on to the house, ultimately they realized an appreciative value on the value of their home, right?
Well, look at this chart. And Sandy and I bought our house in 1992. And I swear we lived there 10 years before it seemed like it appreciated one dime. But there was appreciation. It was 1%, 2%, 3%. And I think the first time it was around 2000. I think I shared with you, we bought this house for about $135,000. And I remember celebrating when the first house sold over $200,000 in that neighborhood. It was like, yes,
we made it.
All right. So the second one, projections of forecasted home prices. So this is a slide that I put out maybe, 2 or 3 months ago. And it talks about 23 being 3.32, very conservative. And then I think the rest of these could be conservative, but who knows what's going to happen. I mean, obviously, this is based on what the inventory is going to be like and what the interest rates are going to be like. But more, when we're talking about estimated home price performance, we're really talking about inventory.
Yeah.
So home prices turning higher. This is a report that came out today. And what it is, it's Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow. Each of these has a little bit different matrix that they score on. But through July, and in Zillow's case, August, they have Case-Shiller 5% for 2023 so far. FHFA, 7%. And one of the things I know about FHFA is they don't count cash deals. That could account for the fact that the home price that they track could be a little bit more because cash deals are usually a little less expensive. CoreLogic, 9%. Black Knight, 8%. And Zillow's at 7%. So that is a very strong appreciation number. And if anybody's out there that's listening thinks that there's risk in buying houses, when you look at the interest rates, I mean, if you look at the chart that I just showed a minute ago, and the interest rates, our interest rates are actually lower than they've been in most of the history that we track. So I think it's positive information. That's that's the message I wanted to show. Now this slide's almost too big for its britches here. Let me go back here. I can't even read the top part of it. Let me find it over here. I've got
it looks like it says housing stays strong through recessions.
Yes. So this is just because we anticipate that there is going to be a recession, and for people that are potentially going to be economically challenged when you have a recession, then it may not be a good idea to buy a house. I mean, if it puts you in any kind of pressure to pay for a house when you are losing income and stuff like that, you want to avoid that. But for those of you that are in strong fields, and I think about the medical field, and I think about other, construction could be a challenge. I mean, there may be less construction during a recession, but there are some that are insulated against some of the recessionary challenges that happen. That you should not worry about what's going on in your housing market. Now, here's one. This chart on the left shows inventory from 2000 through, and I guess because my slide didn't, let me do it here. I can see it over here. There we go. Through 2023. And you can see that the time that we lost on the right side, 2007, 8, 9, 10, 11, that's to right in here, this area, right when inventory was getting its highest. So that's what you have to watch as far as appreciation. Less inventory, more people needing to buy. That makes the value of the commodity go up.
Supply and demand.
That's right. It's all it really is about. I thought this was an interesting slide. I picked this one up. I forget where I got it. Calculating risk down here. Calculating risk blog. This is actually a entity that you pay for, but what it shows is the existing sales in thousands, and then the blue is 2022, the red is 2023. So these are the differences, and obviously we are selling less houses in 2023 than we did in 22. As a matter of fact, since February the number has gone down, and you normally would expect a little bit of a higher boost right here in these summer months. That's when the majority of the market happens. But the market is diminishing, but the prices are still going up, even though we're selling less houses. So I thought this was kind of interesting to compare that. All right, enough of that. Let's talk about second homes. Joe, what do you think about buying a second home?
That looks like Snowmass, and I would love to live in Snowmass. I don't know where that picture's from, but I would love a second home.
Yeah, I tried to pick there's two places that to me make sense buying a second home, and one is around water and one is around mountains.
Yep.
And you can enjoy both those any time of the season. You get the winter months where you can ski, and then the summer months where it might be a good place to go hide from Texas.
When it's 185 degrees outside.
Oh my gosh. Yeah. I mean, I have friends that I literally spent 6 months, it seems like, in Colorado while this summer. Here's another picture I thought was kind of good. This is kind of like one of the beaches. I don't know exactly where this is. It looks a lot like maybe in Daytona. It could be Orange Beach, could be Jacksonville, could be anywhere along those. These are the kind of condos that they build. And you can buy these condos, and they're not that unreasonable. I mean, there's actually, I've seen a show about buying a beach home for, silly dollars, but you could spend, and again, in this market, I don't know, I'm not a realtor. What do you think? What are these houses what would be the price these would go for?
Oh man, now you're gonna get me fibbing. I don't know. I would say probably between 100 and 200,000, depending on.
I think it's higher than that. Yeah, I think when you're on the beach like this, like a condo like this, we stayed at one of these on a vacation 2 or 3 years ago, and we asked because it was a wonderful place, a lot of amenities, and I think that it was being priced somewhere between $300,000 and $500,000.
There you go.
But the rental, and I remember paying more than $1,000 a night for the rental, and during the summertime, you can rent these puppies, pretty consistently
every night. Yeah.
And the other part about a deal like this is the maintenance is taken care of by the condo association. So those are all good things. And it's for people that have I've got a slide back here that's going to talk about that. So buying a second home, answer these 5 questions. The first thing is money. Can you afford it? How will this impact your any other investing? You don't necessarily want to make this your only investment, but it's not a bad investment because homes appreciate. The next question you have is, how often would I use it? And particularly when you're talking about one that is hundreds of miles away, Colorado's got to be 12 to 16 hours away, depending on where you're going.
At least.
Florida is probably 8 to 10 hours away at the nearest point. So, how many times are you going to make that trip? And if you have kids, how long? I mean, the first time you go, coming back, you're not going to want to do it anymore. I can tell you that for sure. Ongoing maintenance requirement. This is a big one because inevitably, particularly if you vacation rental the property, you're going to have maintenance issues. And there are management companies that handle that, but maintaining property value depends on how much time and money you devote to keeping it up. And what will this cost? That's a big factor. How far is it from your primary residence? That's the one we just talked about. A lot of people overlook that. They think that they're just going to beam up to their vacation property. I want to do that. I want to beam up to where I can be in the cool. Yeah. That sounds so appealing right now. And then the rent. Do you plan to rent it out at all or use it solely for yourself? And I've had, people that say, I don't want to let people in my house. And then there are people like me that say, well, I can't afford the house unless I have people in it. So it's a combination of the two things.
That's good in that area.
Professional real estate investors dedicate approximately 40% of their gross rental income to expenses. So who's going to manage rent and rent it while you're away? And the biggest thing that we find is making sure after somebody's in it that it's cleaned properly for the next tenant. And what you're basically doing is you're going into a business that is the hospitality business, really. And unless you're prepared for that, it might not be a good idea. But what you hope is that while you're going through and you get that business to even pay a portion of the cost of your real estate, A, you get to enjoy it yourself. B, you get people to help you pay for it. That's, I think, a pretty good way to buy real estate. Wouldn't you agree?
I agree. I absolutely agree.
So let's go buy some.
I'm ready, man. Tell me where.
All right. So first is, how much can you afford? And you're supposed to ask these questions. How much can I afford? So you ask that. How often will you use it? What are our ongoing maintenance requirements? How far is it from your primary? And do you plan to rent it or use it yourself? And one of the things that I find, particularly the beach properties, these are tricky because salt water and the sand is very destructive on everything, vehicles. I mean, and I don't spend a lot of time. As a matter of fact, I avoid going to the beach personally. The two problems I have with the beach are the fact that, I have more than that. I have the sun. I don't handle sun. I'm a redheaded, freckle-faced kid. I mean, what can I say? Even red, maybe not so red anymore. But I don't do well in the sun. The sand doesn't appeal to me. The water, there are entities out there that have teeth, and I don't want to be the bait.
and you can't see them in Galveston. That's
right. You can't see them. There's nowhere to run. So anyway, I'm even though I'm married to a woman that loves the beach and goes every chance she gets, I will do everything I can to stay out of there.
We're in the same boat, my man.
The mountain's a different story. The lake, we opted to kind of be a transition. There are plenty of good lakes in and around the area. The property is a little more expensive, but again, if you get help by vacation rental, Verbo, Airbnb, that kind of thing, that will help you make that work. And again, it's not for the faint of heart, though. That's for sure. But if you want that, you could call Joe Salas and get him to start a search for you on some vacation rental areas in and around this area. And obviously call me and I'll go through the financing part with you. I've got about a 10 different series of questions that a lot of people asked that I put together. If anybody wanted to get that, you could just contact me at this number, or you can email me. And you know what? That reminds me of something. I can go back here. Let's see and do this. Banners, that's what I need. Put that. There we go. I forgot about those. I do that from time to time. That's got the banner going at the bottom of the thing. You can call us and or get in touch with us that way. Oh, I skipped that one. So net gain by buying a home. So this is another chart, and it talks about the initial closing cost, the cash flow difference, the cost to sell, that kind of thing. And what I think we read a chart that for the longest time, people were staying in their houses 5 to 7 years. And you can see in 5 to 7 years, you start making profit, or you start being in the green, if you will, in about that third year. But it really picks up. And then 5 to 7 years is a good time. But people these days are staying in their houses longer. Have you noticed that, Joe?
Oh, yeah. Yeah. The average used to be around 7 years. Now the average is 9, 10 years.
So in this particular case, based on the appreciation gain, so over 10 years, they've really only figured that the appreciation on this particular property was $65,000. But the amortization gain, and when I say the amortization gain, what that means is we're talking about the note that you started with, you've paid principal to it now, so reduce the cost of that. And between those two things, that adds up to over $90,000. Now, in this case, they've got a figure there of $65,050 and the amortization gains of $34,414. They accounted for the loss in the first 2 years. So after 10 years, $90,261. Now, keep in mind, most people that haven't bought a house never seen that kind of money all at one time. The people that buy houses and stay in them, fix them up, treat them nicely, give them tender love and care, they see that regularly if they stay in a house that long. And sometimes it's hundreds of thousands of dollars. And if they be aggressive at paying the house down, definitely will be hundreds of thousands of dollars. So while you're focusing your pay down and what's the term? Updating the house, it could be a big win, particularly in markets where you're having like the appreciation that's on these properties is very modest. I don't even know what it doesn't, for some reason, it doesn't show us what the average growth is, but it looks like it's somewhere around 4% would be what I would guess based on that. So buying a house, let me tell you, if you are comfortable living in one and you have extra money and you're wondering where to invest, right now, I'm not sure where else you invest. I mean, I do like gold, but after that, maybe silver, precious metals and stuff like that. But where do you go after that?
Dogecoin.
What?
Crypto, Mike. Crypto. Buy lots of crypto. No, I'm just joking. Don't buy crypto.
I'm not sure I would go to crypto. That's a place I'm not
sure. My CPA told me, she was like, stop doing your crypto. And I was like, I was only doing like $100. She goes, stop doing it. I was like, that's no problem.
Yeah, it's funny. The guy that does my taxes has done that also. And he's an investor, a financial advisor also. And I said, look, don't put any of my money in crypto. I'm just not, I don't understand it. I want to understand what I'm buying. And the crypto thing makes no sense to me whatsoever.
It's
But
air.
real estate, I get, and you can tell I have invested most of what we have been able to put together in real estate, and it's been good to me. Matter of fact, we just got our taxes back this week. It was almost too good to me. All right, so this slide, real quick, is a lot of information, and it's more than I can explain right now. But it's basically talking about some of the people out there are struggling with debt, and we talked about this last week. Is the consumers have more debt right now than they've had in a long time. The interest rates on consumer debt have gone just unbelievably high, in the 20+%, some cases even more than that. And it might be, even though interest rates are higher than they are probably on the property that you're in right now, it could be for some an opportunity to get your credit card 20+% debt off the books and put it into a cash out refi. If you handle this cash out refi, and it's a whole scenario that I would go over with you to show that this could be a life-changing event to alleviate all your other debt. I used to say that there's no debt that's good. The mortgage debt is, it's not bad. It's debt. Debt is bad, but mortgage debt at least has the redeeming quality of being tax deductible. It's also at a lower cost. So if you were in a position where you were struggling to make your bills, or you felt like you really needed to change your cash flow, that money, that equity that we're showing in the early things is growing like crazy consistently. You can use that. You can tap into some of that appreciation and get the bills at your house taken care of. Okay. Now, we'll tell you, if you are in credit trouble, it's not a good time. If you've waited too late to take advantage of it, you may have waited too long. So I won't beat that horse anymore. Joe, does that make sense to you? I mean, it's hard for some people to think about going from 2.5, 3.5 to 7.5. I mean, you have to be in a pretty special position to do that. But let me tell you, if you don't see another path out of that, then that money is there to be used, and it's an opportunity for you.
Yeah, that makes sense.
Okay, auto worker strike. The auto workers, and I don't know anything about auto workers. I don't think that we have many in this state. We have some in Austin, I think. I think that the Tesla.
Toyota builds their trucks.
Yeah, and San Antonio, for that matter. The UAW strike, they're asking for a big pay raise, and they probably deserve it. I don't know much about that. I do know that if they are given that kind of increase, which I heard it was substantial, I heard something like 40%. I don't know if that's right or not, but that would definitely cause automobiles to go higher and parts to go higher, and anything that's in that industry. Now, anything that would be inflationary, and at a time when we're trying to fight inflationary things. So it was interesting that President Biden went and supported the strike. I guess he has to, because it's a UAW. That's a pretty big backer of the Democratic Party. But it's a tough one. I think that they have to get these guys more money, and I just hope it's reasonable and that they can work it out. What do you think?
I think that I read an article the other day that said if you're in a market for a used car, you're going to be paying 5 to 10% more than what it was 2 weeks ago before they started the strike. A lot of these big conglomerates are going out and buying a whole bunch of used cars now to make up for the difference of the shortage of inventory that they're forecasting because of it. I think the idea behind what they're asking for is reasonable. Especially if you look at their pay versus the pay and the profits of the companies over the last 4 or 5 years. similar deal was happening with the Writers Guild over in Hollywood. I think the working class, the blue collar workers, and some even the white collar workers, they're seeing that, as inflation grows and these profitabilities of these companies grow, their cost of living is also growing, but their income is not. And there's a disconnect there. And so what you're seeing with the writers and with these auto workers is a display of that uncomfortableness that has been, and it wasn't our, as a group, wanting to have that happen to us. It has happened to us. And now people are using their collective voice to say, hold on just a second. Don't forget that we are the backs that your company is built on, or we are the backs that these shows are written on, that kind of stuff. You even feel it within our industry, Mike, right? Our costs have not gone down. Actually, they've probably gone up a little bit, and our revenue has fallen quite dramatically in some instances. I mean, my revenue is down about 30% from last year, and you feel it. And you have to, in our business, it's a kill or be killed type of situation. We can't band together necessarily. We have the collective voice of the NAR and all of that stuff, but it is really a business where we have to go out and make things happen. It's great that they have their collective groups that they can get together and voice their desires and their wants. I think at the end of everything, though, our nation was built on compromise and people with differing opinions agreeing to meet somewhere in the middle. It's not always the middle. Sometimes it's a little bit right or left of the middle, but you still, that's the way we should operate, is understanding and compromising.
I concur with almost all of that, not all of it. So government shutdown. Here's what I failed to mention last week is this is a real deal.
Yeah.
What happens that affects us, and I'm talking about you and me, on a government shutdown. And I heard this on the news, is that FHA, VA, USDA loans, they're going to be delayed because the people that in the FHA, in the VA, and the USDA are not going to be working. And what happens, I don't know if you knew this, but when they have a shutdown, these guys basically get a vacation, and they may not get all their money while they're not working, but they get it when they come back. In other words, they're fully paid. They don't lose money. They may lose a time period where they are getting the money, but so it just be aware of that. If you are, within, I guess it starts this weekend, 1st of October, they've got to fund it. Isn't that correct?
Yeah, there's something going through the Senate right now. They got a continuing resolution. I think it's passed the Senate, so
kick it down the road. Okay, well, until 3 months from then, when we'll just come back and have this conversation.
Yeah, I mean, you kick it the football down the field a little bit. That's all they do, Mike. You know how it is.
Oh boy. Okay, so had this chart last week. It's basically inflation in the blue and 30-year fixed rate mortgage. This is from 1972. And then the point is that the 30-year fixed is here, which is right about, well, it'd be about here. And you can see, I wish I had some way to draw a line across that, but for the majority of time, rates have been higher than 7%. So this is not that crazy a time. It seems crazy only because we went down to 2s and 3s, but it's not that unusual time. And the other good news is, as inflation curbs, and it seems to be curbing, even though the things we talked about today are not so much, people can still buy properties. They still appreciate, and it's still a market that you can buy. It does eliminate some of the people from buying houses, and I hate that, but it is what it is. This is a look at the bond market. I think I clipped this screen probably about 12 o'clock today, maybe 12 or 1. And this is July on the far left. And it just, as it goes month, and you can see this downward trend. We'd like to think that this was interest rates going down. It's not. When the bond market goes down, interest rates go up. So they had a little bit of a reprieve right in August, the first part of September. And since the early part of September, and particularly this last 10 days, oh my gosh, this was as bad a day as we've had on some time. And that makes rates, to finish it off, here's what rates are today. 30-year rate today, if I were to lock it, be 7.5, assuming that this was midday. 15 years right at, I think it's a little under 7%. Jumbos are 7.375. The ARMs, because there's an inverted yield curve, that the ARMs are actually priced higher in some cases than fixed rates, because the longer term is less expensive than the shorter term, which is that's a sure sign that something crazy is happening.
That's crazy.
FHA was right around 7%, and the VAs were about 7.125. So, Joe, with that, man, there's not all good news, but it's not all bad either.
It is what it is, Mike, and we'll continue fighting the good fight where we are when we need to.
Well, listen, Joe and I both want to thank you for watching. We ask that you like us and that you subscribe to us and make comments. We'd love to hear your comments, how we can make the show better. And again, we thank you for visiting with us. We look forward to talking to you again soon. Okay? Thanks, Joe.
See you, Mike.